Globally, 1.4 billion adults remain unbanked, locked out of essential financial services, while traditional banks generate over $170 billion annually in fees within the US alone. What if you could access credit, earn substantial interest on your savings, or trade assets instantly, all without a bank account, anywhere in the world, 24/7? Today, we're demystifying decentralized finance, DeFi. By the end of this video, you'll understand exactly how DeFi works, the core applications driving its explosive growth, and why it represents a fundamental shift in how we think about money and banking, giving you the knowledge to navigate this financial revolution. At its core, DeFi is an open, global financial system built on blockchain technology. It operates entirely without traditional intermediaries like banks, brokers, or exchanges. Imagine a vast, self-operating vending machine for financial services, accessible to anyone with an internet connection, rather than a branch office with bankers and tellers. This fundamental shift removes the gatekeepers, making finance permissionless. DeFi achieves this by leveraging three key technological pillars. First, blockchains, primarily Ethereum, serve as the transparent, immutable ledger where all transactions are recorded. Second, smart contracts are self-executing agreements coded directly onto the blockchain. They automatically enforce terms without human intervention, replacing the need for legal departments or escrow services. Third, stablecoins, such as USDC or DAI, are cryptocurrencies pegged to stable assets like the US dollar, providing a bridge between the volatile crypto market and real-world value, essential for practical financial applications. These components allow for programmable money and truly trustless interactions. But how does this translate into actual financial services? One of DeFi's most powerful applications is permissionless lending and borrowing. Protocols like Aave and Compound allow users to deposit their cryptocurrency holdings and immediately start earning interest, often significantly higher than traditional savings accounts, which typically offer fractions of a percent. Simultaneously, users can borrow against their collateral, receiving loans in stablecoins within minutes, without credit checks or extensive paperwork. Consider this: a user can deposit Ether (ETH) into a lending protocol, earning a variable APY, perhaps 3 to 5%, while simultaneously taking out a loan in USDC, using their deposited ETH as collateral. This entire process is automated by smart contracts. Aave alone has facilitated over $100 billion in loans since its inception, demonstrating the massive scale and demand for these services. This democratizes access to credit and savings, circumventing geographical barriers and often offering superior yields compared to the paltry 0.01% you might find at a traditional bank. Beyond lending, DeFi also redefines how we exchange assets. Decentralized exchanges, or DEXs, such as Uniswap and PancakeSwap, enable direct peer-to-peer trading without a centralized order book or intermediary holding your funds. When you swap one cryptocurrency for another on a DEX, you're interacting with a liquidity pool, which is a collection of funds provided by other users. These liquidity providers deposit pairs of assets into the pool and earn a portion of the trading fees generated by the swaps. This mechanism is the foundation for yield farming, where users strategically move their capital between various DeFi protocols to maximize returns, often earning additional token rewards on top of trading fees. Uniswap alone handles billions of dollars in daily trading volume, showcasing its efficiency. While yield farming APYs can range from a modest 5% to over 100% in certain dynamic markets, this strategy also carries higher risks, including potential and permanent loss or smart contract vulnerabilities. So, what are the real-world implications, and why isn't everyone doing this? DeFi offers unparalleled advantages: transparency, with every transaction recorded on a public ledger; accessibility, requiring only an internet connection and a crypto wallet; efficiency, often processing transactions faster and cheaper than traditional banks for international transfers; and the potential for significantly higher yields on savings. However, DeFi also faces significant hurdles. The inherent volatility of cryptocurrency assets can lead to substantial capital losses. Security risks, such as smart contract bugs or platform exploits, have resulted in hundreds of millions of dollars in losses, like the $600 million Poly network hack in 2021. Regulatory uncertainty creates a challenging environment for innovation, and the user experience can be daunting, with a steep learning curve for newcomers. Furthermore, scalability issues on dominant blockchains like Ethereum can lead to high transaction fees, making smaller operations uneconomical during peak demand. DeFi isn't just a niche technology, it's a paradigm shift towards a more open, inclusive, and programmable financial system. It challenges centuries of centralized control, offering a future where financial services are not dictated by institutions, but by code, accessible to anyone, anywhere. It's not about entirely replacing banks, but offering a powerful, parallel alternative built on principles of transparency, efficiency, and self-sovereignty. Imagine a world where your savings aren't eroded by inflation in a zero-interest account, but actively work for you, where credit isn't a privilege, but a permissionless possibility. That's the profound promise of DeFi, a direct, unfiltered connection to a global economy. The journey into decentralized finance is just beginning. Understanding its mechanics is the first step towards navigating this evolving landscape. For a deeper dive into specific DeFi protocols like Aave or Uniswap, be sure to watch our next video covering advanced strategies and risk management. Consider this: will the future of finance be dictated by institutions or by algorithms?